Welcome to my channel. I'm the cover call guy, and my goal is to create a $120,000 per year passive income using only cover call ETFs. I currently yield about $70,000 a year and about $6,000 a month. Legal disclaimer before we start this video: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own, and I may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. With that out the way, today's video is going to be on ULTY, YieldMax, ultra high income, ultra high yield, ultra high everything, right? So November 13th, ULTY and the YieldMax has done something very drastic and big. For one, YieldMax has announced that it's doing a reverse split. ULTY's part of it, and then ULTY itself has add 2 additional mega cap into their holdings, into the underlying. Will this actually finally slow down NAV erosion, or is it just marketing BS? They actually added 4: Nvidia, Meta, Salesforce, and Costco. I just want to get that. Let's just I don't know why I said 2. They added 4 mega cap. So let's find out if it will actually do anything. What just happened as of November 13th, 2025, mega cap additions such as Nvidia, Meta, Salesforce, and Costco has been added to the YieldMax product ULTY. This has significant allocations because these new additions represent a combined basket weight of approximately 20%, making a notable shift in their method, right? The methodology has started to change. They're trimming the risk. Position in speculative names like HIMS and MBIS were closed, while SMR, SOUM, and SYM were significantly trimmed. So they are moving the underlyings, switching out the underlyings, and completely just trimming down some high risk, high yield, and closing out 2 basically, I would say, trendy, memey ETFs per se. So they are making changes. They added 4 great companies. We just don't know how they're gonna actually perform now. Is this a buy now, or is it still a hold and watch? I'm excited. Maybe this might be an addition to my portfolio. Again, to all the YieldMax hate comments that thinks I'm a YieldMax hater, I'm not. I just keep an eye on what they're doing, and if they eventually shift, I might buy. As of right now, I'm just watching from a distance. I don't want it to infect my portfolio just yet. Again, I'm not a hater. I just don't like losing money. All right, the Whipsaw Death Spiral, right? It's basically just the old strategy is bleeding NAV and draining actual real total returns, right? The premium collection, the fund buy speculative stocks at 150 IV, like SUN for high options premiums. The downside capture, speculative stocks collapse, right? SOUN collapsed by 30%. The fund captured 100% of this severe loss. Forced call writing. The fund is forced to write new calls at a much lower strike price to meet its income mandate. Upside cap, right? So then that leads to stock has a sharp relief rally, but the fund's gain are capped at the new lower strike price. The NAV takes a big hit. The fund participates in all of the losses, only a fraction of the gain, guaranteeing NAV erosion. So this was it was a literal death spiral. The moment it stopped working, the moment it didn't work out for their holdings, or not, it doesn't even have to be all of the holdings, just one of the holdings, because of such high IV, right? And since it made such a big portion of their allocations, it dragged everything down. So what just happened? Oh, I went back. The new strategy, right? A shift in volatility. So the old holdings, SOUN and SMR, right? They're getting replaced. Two new mega caps, Nvidia, Meta. The new additions fundamentally change the portfolio risk profile, right? This shift from 100 to 150 is now to 50%, right? It's designed to reduce severe price swings and provide a more stable underlying for options writing. They added two fantastic, great companies. So this is just the history of their strategic evolution, right? Feb 2024. That's when there is inception of OT, right? Launched with a focus of high volatility speculative stocks. And then November 2024, risk mitigation introduced a options collar strategy, buying protective puts. And then March 2025, the distribution shift to weekly payouts to reduce NAV declines from distribution, right? And then now November 2025, the mega cap pivot as Nvidia, Meta, and the two other Costco and was it Microsoft? I'll have to go. Let me double check. Not Microsoft, Salesforce. Sorry. So we'll see how they actually perform. I'm excited because if it actually stabilizes the NAV, then this is probably gonna be one of the best weekly ETFs. What does this change, right? What does it fix, right? The pro argument is that it reduced volatility, swapping 150% IV assets for 50% IV assets directly reduces the portfolio's exposure to severe sudden price drops. Adds positive drift assets. The fund now holds profitable mega caps with a long-term positive price trend, right? Not just negative drift on speculative stocks. Concentration, risk mitigation. This move reduces the blow-up risk that could come from a single speculative sector like AI, quantum collapsing, right? So this is a huge change, right? It went from 150% implied volatility to about 50%, right? It went down 100%. So this is a good thing. We just need to know how they're going to execute. However, the unchanged structural flaw, right? So it doesn't matter how much of change you do, especially with good companies, if the structural strategy behind, you look under the hood of the ETF and how it operates, the source of erosion, right? This is they're basically admitting that the fund earns zero traditional income, dividends, interest, etc., etc. Nothing. 100% of its massive 70% plus distribute. Oh my god, I can't say it. Distribution. I don't even know how I'm saying that right. Okay, I'm talking too much today. Must be sourced from 1, options premium, capital gains, and 2, return of capital. So they are actually admitting that they don't make any profits and they have to erode the NAV to make that payout. That's why they're making these changes and adding these 4 companies. The NAV erosion engine. What isn't fixed? The crazy high expense ratio at 1.30%, right? A high and persistent fee structure that creates a significant drag on returns regardless of underlying assets. They're still taking more money away from you. 717% turnover rate. This creates a massive hidden transactional friction on the bid and ask spread. So basically, they're paying more on these on the stocks they buy, right? Which further erodes NAV because you want to buy low, sell high. That's the whole point. And then return of capital, the result of a 0% SEC yield, the fund liquidates itself, right? Its own asset to pay the distribution, the definition of erosion, right? So it has to distribute to you the capital assets because it didn't make enough money, profits from the dividends, options, or whatever, whatever they hold. And then we just look at the historical content, the NAV bleed from when it was inception date. Basically, it just kept going down, 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 and it never went back up. My verdict: 1, it harms reduction, not a cure. Simply, this just means that OT is moving from a high risk speculative bet towards a more balanced but still aggressive income vehicle, right? They're how they're operating, their structural strategy, right? Um, for income focused investors, it's still dangerous, just less dangerous, but still you need to really be an active trader, right? You have to monitor it every single day. All right. So it is more than marketing. It they're actually I feel like they are trying to improve. They are listening to the shareholders because the shareholders really want reduced severity of NAV declines, improve overall portfolio quality, and diversify more. Right, lower blow up risk from over concentration. If you see the death spiral, that's a blow up, right? It just never recovered. And then provide more sustainable premium generation. Actually start making money instead of just 100% return of capital plus an expense ratio shareholders have to pay, right? However, they're not really changing much because the way they're structured is 1.30% expense ratio, which is really high. The excessive turnover rate, fundamental NAV erosion during bear markets. So they have zero downside protection right now. Even with the put protection they have in place, it has shown actual no protection. It just kept going down. And then what they distribute exceed earnings. Like they're not making any money right now. So hopefully with these 4 new caps, they will start making money. So you're gonna have to track at least 4 months of it and see how they actually do for a full quarter. All right, the central trade-off, what to watch now. Scenario 1 is the honest path, right? We want the fund managers to accept the new lower premium reality. The advertised distribution rate is cut to a more sustainable level. This would be responsible and positive. We want them to actually take accountability, saying, hey, we screwed up. Maybe 70% payout is not sustainable. Let's do 50%, right? And then scenario 2, the marketing path, right? The fund fights to maintain a 70% yield, so then they don't have an extreme outflow of capital, right? No investors. Everybody just doesn't buy it anymore, right? To fund this, it is forced to increase its return of capital, which then just accelerate the NAV liquidation, meaning doesn't matter what they add, it doesn't matter. They can add the Mag 7 plus 15 other great companies from SP 500, Russell 1000, Russell 2000. It won't matter, right? Because that yield is almost unsustainable if they can't make the money. They don't have the options profit. My verdict, it's a potential path to reasonable. Reasonable mean they really have to do something about that payout yield, and figure out an actual plan, right? If YieldMax continue this trajectory, adding more mega caps, reducing leverage, and cutting the distribution to sustainable levels, OT, I believe, could eventually become a reasonable but expensive tactical income tool. Meaning, I would buy OT, but I would not drip it. What I would do is, if it becomes enticing for me to buy into it, I would buy it, not drip or reinvest any of it, but use that income to build another solid portfolio, an actual long-term hold portfolio. That's what I would do. And my verdict would be for accumulation phase for someone in the early 30s like myself, income focused, but still in the accumulation phase. OT is not appropriate just yet. Even after this improvement, the goal is wealth creation, not capital conversion. So until they can actually fix their underlying issue, someone like me in my early 30s that I'm very income focused, right? I need to accumulate. I'm trying to build both income and my capital appreciation. OT right now does not hit the mark, but when it does, I will use it as a tactical income tool to build other great positions. It would be more of a satellite position, maybe a little bit depending on, it would be satellite or just beneath a satellite, right? It would be more of my this is for fun type of holding. But as right now, I'm staying far away from it. I'm just gonna keep an eye on it and see what the fund manager does. That's the end of it. Subscribe, comment, like. I wanted to make this video because I made a video yesterday about the YieldMax stock split, and it means absolutely nothing if they're not gonna change anything. And I just read up on OT doing some changes with the stock split and the removal of their and changing of the underlying. So I found that very interesting. I felt like I wanted to share my thoughts. OT is going to be a very, very interesting cover call ETF to have on your watch list, because if they're actually serious about changing, OT might actually be a game changer. So thanks for watching. Stay tuned. Catch you guys on the next.